Hello everybody and welcome back to part 2 of module 4. We're still dealing with long-term assets and depreciation, but now we're going to move into one of the last topics of the depreciation methods. And this specifically is the declining value methods, or declining balance as they're sometimes called. Now there are a few variants of this. The one we're going to talk about is the double declining balance, double declining value. But there's also the 150% declining value or declining balance, and I'll explain the difference in those in a bit. But before we do that, I want to stress that these methods, these declining balance methods, are known as accelerated depreciation methods. And what this basically means is you're going to take more of your depreciation in the earlier years than you do in the later years. In total, we're still subject to that same rule. We have to only take up to the depreciable cost. That's all the depreciation we can take. But there are a couple differences that are important here. So first of all, what we have to do is calculate, we didn't mention this in the straight line method, but we need it now in order to double the rate. So there's another way to calculate the straight line rate as a percentage. You know, when we talked about the straight line method, we just went straight for the dollar amount. We said take the depreciable cost divided by the number of years to get the amount of depreciation. You could have also done that in a percentage format by taking essentially 100% divided by the number of years in the asset's life. And in this example with a 5-year life, we would have got 20%. Or I think earlier it might have been a 10-year life, so it would have been 10%, 100% divided by 10 years. This, of course, this is multiplied by the depreciable cost. Now, the reason we need to do that for this double declining balance method is that we are going to double that rate. So if we got 20%, if it was a 5-year life, then we double it to get 40%. If it was a 10-year life and we got 10%, we double it to get 20%. We'll see an example in just a bit. But whatever our rate is, we're no longer multiplying it by just a static, steady, depreciable cost. Instead, that's where the other two words of this name come into play. You know, we saw where the double comes from. We're doubling the rate. The declining balance or declining value means that every year we're multiplying this rate, this percentage, by a declining balance. And specifically, it's the beginning net book value for that year that's being multiplied by that rate. Every year that balance declines, and that's where the term comes from. Here's the thing that I want to stress very heavily, because it's the one thing that'll throw you off completely. This is the one method where you completely ignore the salvage value. Up front, I want to stress that. So you don't calculate a depreciable cost up front like you do with the other methods. Instead, this 40% is going to be multiplied by the beginning period net book value. And by beginning period, I mean the beginning value for each individual year. So because of that, if we just went with this calculation, our depreciation would not end up right at the salvage value. It's not built in, so to speak. So generally with this method, you have to make an adjustment in either the last year, maybe the second to the last year, sometimes even the third to the last year. The point is you need to adjust it so it doesn't go below your depreciable cost, or so it doesn't go below your salvage value, and also to make sure it does hit the salvage value if it didn't quite do it based on the calculation. Now, exactly when you need to make that adjustment depends on the exact life of the asset, whether you're using the double declining balance method or the 150% declining balance method, and also the salvage value. We'll see a few examples here in just a bit. So let's say we have a 10-year life in this case. 100% divided by 10 years is going to be a 10% rate. Now we need to double it, so we get a 20% rate. Now notice we have a $10,000 salvage value, so that's our stopping point. but we have a 10% rate that we doubled to 20%. That's going to be multiplied each and every year by the beginning net book value of that year. So for year one, our beginning net book value was the full $100,000 cost, multiplied by 20,000 or by 20%, gives us $20,000 of depreciation. And of course, that brings the ending net book value down to $80,000, which carries forward to year two. Now we have $80,000. We'll multiply by that 20% to get $16,000. That brings us down to $64,000 we have left. You can see year three, $64,000 multiplied by 20%, $12,800. We keep doing that year after year. But notice at year 10, if we just did the calculation, it only drops us down to $10,737. Now, depending on whether if we're selling that asset right away, we might just go ahead and record a gain or loss, which we'll see in the later slides. But generally speaking, you would want to adjust this to exactly get you to $10,000 salvage value. So what that means is we don't want to use just the calculated amount. We started the year with $13,422. We need to get to $10,000, so we need to take $3,422 of depreciation to get there. And if we do that, we end up right at $10,000. Now let's go a different route. Let's say this was only a 5-year life, which 100% divided by 5 years gives you 20%. Double that gives you 40%. So notice in this one it's even more drastic. We have 40% of the assets cost right away in year one. And we do the same calculations year after year. But now notice by the time year 5 comes, if we do the calculation, we would go quite a ways below the salvage value of $10,000. So again, you cannot do that. And what that means is the last year, or really any year as you're going through, you take a look at what the calculation would be and you determine if you were going to fall below the salvage value. And if you do just like we did a bit ago. We have $12,960. We know we need to get to $10,000, so we can only take $2,960, not this calculated amount. If we take $2,960, we end up right at $10,000. Now that takes us through all of our depreciation calculations. We're going to talk about some gains and losses. We're going to talk about repairs and maintenance expense. But before we do that, I wanted to continue on and talk about a couple of other classes of assets that are treated very similarly to depreciable assets. The first one is called an intangible asset. And intangible basically means it has no physical substance that you're using. It's very important. It's usually a legal right or a contract, something like that. So arguably it's a piece of paper or an electronic document, but you're not using it physically in your operations. It's still very valuable in many cases. So these things, we have a few different types. There are probably more out there. These are the main ones. We have patents. Now, I'm sure you've heard the term patent. It protects an inventor from being copied, basically. There are a couple types of patents. We have utility patents, design patents. We won't get into the details of that, but I just wanted to throw out the contractual life of those or the legal life of those. Utility patents are 20 years. Design patents are 15 years. This has actually changed over the decades and even over the centuries, the legal life. It's now at 20 years. What this means is if you invent something, you're protected from copying for 20 years to hopefully recoup your research and development. But the point here, that becomes the maximum life we would allocate this cost over. And by the way, I want to mention here, I'll see it in the next slide, but it's similar to depreciation, although it's called amortization. It's the same idea. We're spreading the cost out over the life of the asset. But one thing I want to mention with patents, first of all, is that maybe that's not going to be valuable for 20 years. If we have an invention, like a fad, it's something that we invented, and yeah, it's going to be popular for maybe 3 or 4 or 5 years. If we have an idea that's the case, we don't think it's going to last 20 years, then we need to spread it out over its useful life, its expected useful life. So again, that may be less than 20 years. Maybe we think this particular technology we invented is going to be obsolete in 5 or 10 years. Something bigger and better will come out. It's not a copying, it's just something better altogether. So again, we want to divide it by the actual useful life if we can estimate it, but certainly no more than the legal life. The other thing about a patent is that if you, under the U.S. law, and this is actually accounting, not law, accounting requirements, GAAP, you cannot expense, you cannot capitalize research and development costs, which may lead to a patent. You just cannot do it. You have to expense that right away. That's a controversial or contentious GAAP requirement. International standards does not treat it the same way. But under U.S. GAAP currently, you have to expense research and development, which basically means this patent asset is generally only going to be legal costs. Legal costs to actually get the patent, unless you're buying a patent from another party. At that point, you can record that whole asset cost and amortize it over the life. So that's a little bit of information about a patent. A copyright is a work of art, a book, even software has copyright law behind it, a song, things like that, movies. And they are good for 70 years after the death of the author. Now that's in order for them to pass some of it down to their estate and their family and such. So that's what we have there. Trademarks. Here, these can be renewed indefinitely. So these are, again, basically legal fees unless you purchased it from somebody. Franchises, these are contracts. You have the right to operate under another company's name. A leasehold is the ability to lease an asset for an extended period of time. It's a contract again. Leasehold improvements are after you have a lease, if you've added new fixtures or new walls or something to that building that stay with the building, you can amortize those expenses as well. Now, goodwill is a topic we need to discuss a little bit further. It has had a different treatment in U.S. GAAP over the decades, but basically goodwill is when, let's say, Company A purchases Company B for, $2 million. But if you take a look at all the fair market value of the assets that Company A bought from Company B, or that Company B has, I should say, let's say it only equals $1.7 million. And let's assume there are no liabilities being passed on. So you may question, why did somebody pay $2 million for something that appears to only be worth $1.7 million? The answer is that additional $300,000 probably reflects certain things of value that both parties know about, but that can't really be reported on a balance sheet as a separate asset. There are things like a loyal customer base, a loyal employee base, strong management policies, just a reputation that is not otherwise recorded as an asset. There are plenty of those things that you can't really grab a hold of and put them on the balance sheet when you make them, when you earn them over time. So the only time they'll ever show up as an asset is when some other company pays that amount to buy the whole company, including those really, really intangible types of things. So that's what goodwill is. So with goodwill, this cost used to be amortized over 40 years. Decades ago, back around 2000, 2001, up until that point, it used to be amortized over a period of up to 40 years. Then in 2001, there was a big change where the U.S. GAAP, the FASB, now said, instead of amortizing it evenly, just on a straight line basis, we're going to force you to take a look every year to see if that goodwill really still exists. So you test the reputation, the loyalty of the customer base, all these really, really intangible types of things. And there might have been a markdown in a year. There might have not been a markdown, but there would never be an increase unless they bought another company. So that happened up until very recently. It's not finalized yet, but there is a change that's looked like we're going back to amortization over a 10-year period. The point is they don't want this value to stay on the balance sheet very long because they really think it dissolves much more quickly than maybe some companies think. So that's the point with that. But back to spreading that cost out. The term is amortization, although it's very similar to depreciation. It's one of those things that really makes you wonder, when they were developing accounting concepts and terminology, why did they give another term for something that's essentially the same thing? It's the same calculation as straight line depreciation. The big difference is generally there's no salvage value. Think about it. If you have a patent that's only good for at most 20 years, as soon as 20 years hits, all you have left is literally a piece of paper or electronic document. There's just no salvage value. Now we'll move on to natural resources, another group. Now, I want to stress here, this is not land itself we're talking about. These are assets that are within the land or on top of the land. Could be oil, coal, gold, any of the minerals you might mine, trees, which are natural resources. There are a lot of natural resources that are within, on, around the land that can be used up. Some renewable, some not. With these assets, we have yet another term. It's called depletion. You're depleting natural resources. You're pulling them out of the land as opposed to depreciation. It's similar in calculation. It's the same basic calculation as units of production depreciation. And you have to estimate the number of tons of whatever mineral or barrels of oil, whatever you're pulling out of the land. Estimate the expected amount, and then deplete it down to that, spread the cost out over that life of that asset. The key thing to point out, though, is the land itself has separate reporting. And again, it does not get depreciated. Any equipment that you use in your excavation is also separately reported, and it'll be depreciated. So that stays the same. So now I have one slide here I wanted to mention about repairs and maintenance, and I'll even say extraordinary repairs and maintenance. You have ordinary or extraordinary. If it's a routine or ordinary repair or maintenance, so an oil change, putting new tires on a vehicle, just minor repairs to a house or a building, things like that, if you have to do these just to keep the asset operational in its current state, that's called a routine repair and maintenance. And it's referred to as a revenue expenditure, which I know sounds contradictory, but the point is it's telling you you must expense it immediately to offset it against that revenue for that period. You do not spread this out. You do not carry it forward. You expense it immediately in that period. Now, if you have a repair or maintenance that actually is not normal and routine, it actually adds longer-term value to the asset. Maybe it adds utility. It makes it do something it otherwise wouldn't have been able to. It extends the life of that asset, or it adds value overall. Maybe you've added a hospital wing to the hospital. Now you can do more things with it. In these cases, they're extraordinary costs, and we would capitalize them. Instead of expensing it right away, we would capitalize that just like we did the original asset. Now, depending on the situation, we might be able to capitalize that as its own asset and depreciate it separately. But in other cases, it gets merged with the original asset, and we have to recalculate depreciation going forward. That might be a situation there. Now we have a few slides here. I want to talk about one more topic with gains or losses on the sale of assets. I said at the very beginning that the decrease in the net book value from depreciation doesn't always and is not expected to match the decrease in the fair market value. From a personal perspective, we think about fair market value, but from an accounting perspective, that's not the goal. So the point here is at the end of the asset's life, when we do get rid of it. Either we sell it, we trade it in, we donate it, we scrap it. Whatever we did with it, we have to pull it off of the books. We have to pull everything related to it off the books, the accumulated depreciation, the asset, and if we got cash for it when we sold it, we'll have to put that on the books. So we're going to have a mismatched entry, and the difference is going to be a gain or a loss. So let's take a look at an example. Let's say we sold an asset at the end of year 5 from this depreciation schedule. We sold it for $40,000. At the end of year 5, we were at $32,768 net book value. So to us, that asset was worth $32,768. We were able to sell it for $40,000. We sold it for more, so that's considered a gain. Now, when you think of a gain, you tend to think of a good thing. You've gained something. But the question is whether that's really a good thing. And the answer is not really. It's not a bad thing. It's not a good thing. What it basically means is we took so much depreciation throughout the asset's life that we dropped this thing below what its fair market value was. Again, we weren't really trying to match it, but we certainly did not match it here. We declined it so quickly that we went below fair market value, so we have to adjust through a gain. So the journal entry in this case is going to be to debit cash for whatever you received, $40,000 in this case, and then you have to get both the accumulated depreciation and the equipment off of the books. Accumulated depreciation had a credit balance, so we need to debit it for $67,232. That's this amount right here. That's our running total at year 5. The equipment was still recorded at the full $100,000, and it had a debit, so we have to credit that. And to balance out, we have a credit to the gain on sale for $72.32. Everything balances out now. Gain is similar to a revenue. We talked about, or we will talk about why it's slightly different. We're not in the business of selling equipment. We just happen to do it this time. That's the point. In this case, we sold the asset at the end of year 5 again for only $30,000. Remember, at the end of year 5, our net book value was $32,768. We're saying the book value is $32,768. Well, we only sold it for $30,000, so this is a loss of $27.68. The question here is whether this is really a bad thing, and the answer again is not really. It's not bad, it's not good. What this means is that we didn't take enough depreciation throughout the life to push this net book value to where it truly would have been if we wanted to match it up with fair market value. It's not a bad thing. We weren't trying to, but the point is gains and losses are created because our depreciation is not trying to match the decline in fair market value. That's the point. Now for this one, most of the journal entry is the same, except instead of having a credit to a gain, we have a debit to a loss for $27.68, and of course our cash was just a $30,000 debit. So when we add all three of these debits up, we get the same $100,000 for our credit. So in summary, we've talked about quite a few things related to these fixed assets over the past 2 parts of this module. But remember that depreciation is an estimate. The estimated life can change. The estimated salvage value can change. We talked about how the cost itself could change if we capitalized, a new wing or a new engine. We also can change the method. Maybe we believe straight line is the method we want to use, but then midway through the life we change to double declining balance. We just have to recalculate it with what the remaining cost is. We almost treat it as if it's a new purchase with whatever the net book value is at that point in time being the purchase price. That's essentially how we treat it calculation-wise, and then we just adjust our depreciation going forward. Possibly a new life, whatever the remaining years of the asset's life would be, maybe a new salvage value, things like that. So the point is, to understand depreciation, you need to understand what method you're using, how to use them, and how to calculate it, and you also need to know the journal entries. So hopefully this has helped to clarify the topic of depreciation and fixed assets. Thanks for your time, and I look forward to talking to you in our next module. Have a good one.